The presentation today is on commercial financing disclosures, and our speakers are Shervin Rushdie, Robert Hornby, and Andy Alper. If you have any questions throughout the program, feel free to use the chat function that should be either on the bottom of your screen or on the right, and we'll field those questions and ask our panelists throughout, just so you can have those items addressed. And then stay on with us after the first hour, because we're gonna have about 30 minutes of networking at the end. And we're gonna open that up so we can all see and talk to each other and have a little chat with each other and catch up. So with that, I'm gonna turn it over to our panelists. Gentlemen.
Hi guys, welcome. Andy was going to lead off in California, and certainly when he jumps in, he can talk about California, because I know there's been a lot of developments there, and everybody really needs the guidance as to what's coming out of those regulations. But I'm going to start off by talking about what's going on in New York. And I will tell you, we have very up-to-the-minute type data, because there have been some big developments. And actually, there has been some developments this week, in fact, on Tuesday. So, I want to start by saying, I think everybody here is probably aware by now that in July, the Assembly and the Senate passed a bill, essentially the State Truth in Lending Act bill, which was modeled after California's act. That was sent to the governor in early December, and Governor Cuomo signed it on December 23rd. So as it stands right now, the law would take effect 180 days from December 23rd. So that would be June 21st of this year. The good news is that it looks like the amendments that were just put in place will change that effective date. So I want to lead with good news, which it looks to me like we're looking at January of 2022 for implementation, but I'll go through that and sort of tell you where we're at. So as of right now, though, it is a passed law. It's in effect. It's under Article 8 of the New York Financial Services Law. And when the governor signed it, he actually issued a statement, Governor Cuomo, saying that there had been some disagreements, that there had been some, of course, lobbying efforts where people were still opposed to what had been passed. But he was going to sign it anyways, because he had secured an agreement with the legislature to make, quote unquote, technical changes to the law. So it's a little bit different in the sense that he was signing it and then they were going to change it after the fact, not through regulations, but actually through the law. So we had no idea what that agreement was or what those technical changes are. And the way it works in New York, technical changes is sort of a term of art that allows them to sort of pass it through very quickly, pass amendments through very fast. And what has happened since the 23rd is that there has been a new bill that has been introduced. And that bill, for everybody's reference, is S898 in New York. And that amends the current law, which is the law that was just passed, and adds these quote unquote technical changes. I will tell you, looking at the changes, there are some substantive changes, and they're not just technical. We will go through some of those. The biggest one, and I hate to be a bummer and lead with something that is just crazy, because this is a little bit crazy. There was a threshold for whether or not you have to make the disclosures at $500,000. So anything below $500,000, you had to make these disclosures under the law for. That looks like it's going to be changed to 2.5 million. So, the purported law, the purported genesis of this law is to help small businesses. And, frankly, I don't know of a lot of small businesses that are in one pot taking 2.5 million. So the breadth of this is getting bigger. And, as we'll go through some of the key provisions of the law, I'll try to answer your questions on these. What's clear is, even though it says it's aimed at small businesses, really it is the determination of whether you have to make the disclosure is based upon who you are as a provider and this dollar threshold, which really has nothing to do, I think, policy-wise to small businesses. So in any event, to get back to this, the other important, 50,000 foot thing to understand is the Department of Financial Services is very involved in this, and they're going to promulgate regulations. I have a feeling it's going to the same thing is going to happen in New York that happened in California, which is we are going to get a lot of rounds, or at least a couple of rounds of regulations. They're going to be put out for comment. And then obviously, I think everybody on this call understands there is a great deal of lobbying from all sides on these bills. ELFA has been instrumental in lobbying and taking the position, that we would advocate as people in the industry. And actually, they've got some concessions that are really helpful to our industry. But that's going to continue, and that's going to continue during the notice and comment period. So those regulations, which will sort of go through, what the law says that they're going to do, but they're very broad, and they give the Department of Financial Services broad authority. So I think you're going to see a lot of this, as far as the details, calculations, formatting, etc., fleshed out in those regulations. So, as I said, the update is this bill got introduced in early January. It actually passed the Senate already on January 19th, which was Tuesday. And so the major changes to the law are that 2.5 million, the effective date, and they also want to add a new exemption to this. And we'll talk about exemptions generally when we get to the law part of it. But the exemption would be for auto dealers as a recipient of loan funds. They would be exempt from it. You have to make a disclosure to them. So let's go back and just start generally looking at the law and what's covered. And really, it's the term that they use, commercial financing. And there are really 5 categories of commercial financing. And by the way, guys, as I go through this, either, at the end, you can ask me questions on this, or if you need specifics or you need me to email these to you, please, I'm happy to do it. I have this information, so it's not a problem. So, that way you can listen and understand what's going on. So as far as commercial financing, there's really 5 categories, and the disclosure requirements really depend on what category you fall in. The very good news is that, ELFA lobbied hard, and I know Scott Reel at ELFA was instrumental in this, in getting true leases excluded. So true leases are off right away. So we don't have to worry about that. But the categories of what is considered commercial financing are open-ended financing, credit line, etc., closed-ended financing, sales-based financing, factoring, and then a catch-all of other financing. So it sort of catches everything there. The one that really is important to us, obviously, you could be doing obviously open-ended credit as well, but is this closed-end financing. And closed-end financing is specifically defined to include a closed-end extension of credit, secured or unsecured, including equipment financing that does not meet the definition of a lease under 2A103. So in other words, your EFAs, your normal equipment finance agreement is going to be included under this definition of commercial financing. And importantly, commercial financing is commercial in the sense that the individual is not using it for personal or household, use, the typical sort of tag along that's there. One thing to note here before we go on is that it appears, at least, again, the regulations are going to flesh this out. The way that it's worded, you need to get a statement of intended purposes from the debtor, meaning that this is commercial financing and it's not going to be used for, it's going to be used commercially and not primarily for household or personal purposes. That can be in the documents, finance documents themselves, or it can be orally gotten and you can put it in your file. But that is a requirement that sort of stands out there. So given commercial financing is very broad, we know what it encompasses. Who does this apply to? And it applies to providers of that commercial financing. Again, providers is very broad. Providers means a person who extends a specific offer of commercial financing to a recipient. Okay, and the specific offer means specific terms of financing, and certainly you can have caveats in there, but if you give the specific terms about the financing itself, and if that individual can then accept that, that's going to be a specific offer. The interesting thing about the definitions, and again, look at the regs when they come out, is that provider also includes a person who solicits and presents specific offers of commercial financing on behalf of a third party. So the way I read that, and I think the way it's going to play out, is that brokers are going to be included here and be subject potentially to having to make these disclosure requirements. So That brings us to the exemptions, which I'm sure everybody wants to hear because those two things are very broad. And as of right now, there are 6 exemptions. There's probably going to be 7 with that auto dealer one that I mentioned to you. The first one is for financial institutions. That, of course, means banks, state, federal, industrial loan companies, federal chartered savings and loan, sort of the typical financial institution. It, however, at this point does not include affiliates. Another exemption in here, of course, is what we talked about, which is the threshold amount. As it currently stands, it's $500,000, just like California. But it looks like it's going to get moved up to 2.5 million. So obviously, if you're at 2.5 million on a single transaction, you're not going to have to make those disclosures. Another is commercial financing that is secured by real property. That's exempt, no disclosures. A lender under the Farm Credit Act, if you happen to fall under that. The auto dealership that we talked about. And another one that this may affect some people is any person or provider who does less than 5 commercial financing transactions in New York in a calendar year. So that may be an exemption that you could actually take advantage of. Again, I should just say leases obviously are the other exemption. Leases are out, so you don't have to worry about that. Looking specifically at, turning to what the authority that's given to the Department of Financial Services, it's sort of telling as to what they think is going to be included in the regulations. So they're giving power to promulgate such rules to, quote, develop and prescribe disclosure formatting to be used by providers that allows for the recipients to easily compare financing options in a clear and conspicuous manner. What that says to me, it sounds like they're either going to have a sort of a safe harbor form to use or really lay out specifically what the format is going to be that you're going to have to hand to the debtors. And the other thing that they're also charged with promulgating is to designate a method for disclosure. And this is probably going to include, the calculation methodology out there. I know that's probably a big question. We'll talk about that. But that is what they've been charged with. So you're going to see a lot of substance, I think, in these regulations. So when it comes to the disclosures that have to be required, I'll go through them. They're very similar, but I'm going to go through closed-end financing very quickly for you. But they applied mainly across all 5 categories, obviously with factoring and open-ended. There's going to be a little variance as far as what the disclosures are to be required. But generally, it's the total amount of the commercial financing and the disbursement amount if they're separate. The finance charge, and that importantly references back to the Federal Truth in Lending Act. So the calculation methodology, at least in the statute itself, says if you want to look to what's included in finance charge, go to the Truth in Lending Act and take those charges. I think we'll see DFS, sort of tease that out a little bit. One that's important, obviously, is the APR, the annual percentage rate. You can only use the words annual percentage rate or the abbreviation APR, nothing else. And it has to be expressed in a yearly rate, inclusive of any fees and finance charges that cannot be avoided by a recipient. And again, it's supposed to be calculated in accordance with the Federal Truth in Lending Act. Another one is the total repayment amount, which is the disbursement amount plus the finance charge. The term of the financing, obviously, the payment amounts, and those vary depending on obviously the type of commercial financing that you have here, and a description of all potential fees that could be avoided, late fees, etc. You have to put all of those out in this disclosure document. There's also a disclosure requirement that if they're going to pay this off early or refinance, you have to actually lay out for them the finance charges other than interest, any prepayment penalties, whatever it might be. You got to lay it out in this initial disclosure. And a very important thing is the disclosure itself. The way that it's worded, and I've gotten this question many times, do you have to get the sign off from the debtor? The answer is absolutely yes. The law is clear that you're going to have to get the debtor to sign off on this disclosure. And the key here, and we'll see what the DFS does, but they have to sign off on it, quote, before authorizing the recipient to proceed with further commercial financing further commercial financing application, meaning that this disclosure cannot go along with your regular finance documents. You have to present it to the individual, to the company. They have to then sign off on it. Then you can proceed with papering the transaction. So, that is sort of a general overview. We're going to have, obviously some discussions on these points, and I'm happy to answer any questions on these. I don't know if Andy is on to sort of give an overview of where we are now with New York. I'm sorry, with California.
I'm here.
Hey, Andy, sorry, I didn't mean to steal your thunder there. You're supposed to be first.
I know. And unfortunately, I guess because I'm an old guy, I thought that it was 1 o'clock Pacific time, not Eastern time. And since I'm in
Everything
California,
is East Coast time. There should never be Pacific time.
well, luckily, Chad sent me an email and said, "Hey, where the heck are you?" So I was able to jump on and listen to most of it. Sorry for the delay. My name's Andrew Alper. I'm an attorney out in Los Angeles. And I was going to talk first about the latest on the California law on the new required disclosures, and then Robert was going to come behind me, since New York is kind of a copycat law to California, other than the fact that New York is decided to surpass California with this latest $2,500,000 ceiling, which is pretty awful. But anyway, let me go back, and I'm going to try not to repeat everything that Robert just said, but let's talk about California. And by the way, one of the things I was doing this morning as I talked with the regulatory body in California, which was called the Department of Business Oversight, which was called the Department of Corporations, and as of September 29th, 2020, is now called the Department of Financial Protection and Innovation. I don't know why names have to get changed, but that's the way it is. On September 30th of 2018, the legislature had passed what was known as Senate Bill 1235 in California, which is now codified in the California Financial Code under sections 22,800 through 22,805. And the whole idea was it required a provider of a commercial transaction or commercial financing to give a recipient certain disclosures at the time the provider extends an offer of commercial financing. And just like what Robert said, you're going to have to provide the disclosures prior to entering into any transaction. And so brokers out there aren't just going to be able to, shop everything around and say, hey, here's what the rates are. They're going to have specific disclosures. And otherwise, there could be problems. And I don't know what that's going to do, with the broker funder relationships here. But everyone, is going to need to know, if you're doing loans under $500,000 or $500,000 and less in California, you're going to have these disclosures out there, and the brokers are going to have to share them, and unless the providers are going to give them directly. What happened, though, in California is the law has not gone effective. And the reason it didn't go effective is it was like a piece of Swiss cheese. There was so much left open in this law, and what they did in the statute itself is it said it wouldn't become effective until such time as the Department of Business Oversight at the time provided regulations as to how to do things. So, for example, you didn't know what the interest rates were going to be. You didn't know about APRs. You didn't know how to calculate anything. You didn't know what happened in a factoring transaction, as to whether or not you have to show absolutely everything that could be factored under the sun. And if you agree to factor $2 million of paper of receivables, how does that fit into the $500,000 limitation? There are so many things that were left open. It's been ridiculous. So over time, I'm going to call them the Department of Business Oversight, or the DBO, just because it's easier for me rather than this new name. They have come out with various regulations, and every possible financial trade association, law firms, lenders wrote in for comments on them, as to do this and do that and do this, and this isn't understandable, etc. So they've gone through these comment periods. I know that Scott Reel under ELFA has a group of people, of which I'm one, and Wells Fargo was Charles Cross and Stuart Abramson over there have been taking the lead on communicating directly regarding the various issues that affect both leasing and financing transactions. And it was actually through ELFA that the exception to this law regarding leasing and true leases was put into the law. And so that's why true leases are not part of this law. But in any event, it was signed into effect in September. The last comment period was in September, and it ended in October. And if no one else requested any more hearings, the law was supposed to become effective as of January 1, 2021. There was a 6-month period from the date of effectiveness as to when everyone had to comply with the law. So if it became effective on January 1, the date when everyone had to comply was July 1 of 2021. Well, I know ELFA had some more comments. There was a hearing on November the 9th, and they took the comments under submission. So this morning, I actually talked with the Department of Legislation at the DBO, and I asked them what's the status, because I would have assumed, that they were about ready to go here to have it become effective. And I'm sure everybody will be happy to know that they're not. And probably they won't have their final regulations until the middle of this year. So if that's the case, you may not see this effective, and you have to comply with it until the beginning of next year. And so that was the latest from the Department of Business Oversight. And I read to you the following. We estimate that the final draft will likely head to OAL, I'm assuming that's the legislative people, towards the end of this year, with its effective date sometime early next year. And that was from the Deputy Commissioner for Legislation from the DBO. So as we were out here kind of playing Paul Revere with respect to the fact that we thought these things were going to become effective this month and then have to comply by June 1 or July 1, it's not going to happen, which I think everybody's going to be very happy about. And if that's the case, you can all leave right now, and we don't need to talk about it any further. But under the new law in California, it's the same thing as Robert just said. 500,000 and below, you have to have disclosures, and you have to present the offer of disclosures, of all the disclosures, in advance of any documents being signed, and they have to be separately signed off. The exemptions of this law out here, again, you have the $500,000 threshold, a provider that's a depository institution. So unlike commercial finance lenders licenses in California that are applicable to subsidiaries of banks. That is not true with this law. So, and the bank has to be a depository bank because not all banks are. And so if you're not a depository institution, and of course, depository institution is defined. I mean, you could be a savings and loan or an industrial loan company or whoever takes deposits. But unlike the commercial finance lenders license law, where a subsidiary doesn't necessarily have to be licensed, it is not exempt from this law and has to provide the disclosures. Providers that are regulated under the Federal Farm Credit Act aren't part of it. Now let's talk about the fact that the same thing Robert said about commercial financing transactions secured by real property. This was a very interesting discussion that we had in the committee on ELFA, as whether or not we wanted clarification what that means. So for example, what if you're secured by both real and personal property? Does that mean you have to provide the disclosures or not? Because there's real property in it. What if you've got fixtures that are part of the real property? What does that do? So there were some people who wanted to get more clarification on this and others like me who didn't, because I wanted to be able to argue that if I'm secured by personal property and real property, that the real property takes precedence and you don't have to do disclosures. I didn't want them to specify exactly what that means. And my faction of our group won. And so we didn't ask that get clarified at all. So if you're taking real property as collateral at all, at least you have a very good argument that you're exempt from having to give the disclosures if you fail to comply. I would tell you to give them anyway, but if you fail to comply, you've got something to fall back on. The auto dealer exemptions that Robert talked about, that is an exemption in California. What is different, though, in California from what Robert said, in New York, you're exempt if you make less than 5 transactions a year in New York. You're exempt in California if you make 1 transaction a year or 5 transactions incidental to your business. And no one knows what that really means. Because there's no definition for that. It's not that same thing, that same phraseology is used in the financial lenders law. So I've always used the following example as incidental to your business. John Deere, and we're assuming John Deere doesn't have a credit company, sells a tractor. Potential buyer comes to John Deere and says, look, I don't have the money. Will you finance it? Well, John Deere's business isn't financing tractors, it's selling tractors. So they agree to make a loan to this guy because he needs financing, and they make 5 of these in a year. I look at that as being incidental to your business. Let's say you're a company that does leasing only, but you decide you're going to make a couple of loans. Is that incidental to your business? I don't know. So that's kind of left open as well. What incidental to your business is. It's not as clear cut as Robert just told you about New York law. But those are various exemptions. Now, the true lease exemption is there in California. Generally, true leases are, with purchase options of 10% or more. There's 3 cases out here in California that kind of use that as the demarcation line. Fair market value should be, but isn't always necessarily. I would say most courts will not look at that fair market value as being anything other than a true lease. But I mean, what if you're making a bunch of computer loans that are 10 years old, for 10 years? I mean, it's obviously there's no value of computers at the end of the lease term. So, but in any event, true leases are excluded. Conditional sale contracts are excluded because they're not considered lending. I know that that's kind of one of those questions that we were going to be asked, but what's the difference between a conditional sale contract and a lease with a dollar purchase option? You know, on a conditional sale contract, you know, it's going to say there's a buyer and a seller, not a lessee and a lessor, or a debtor and a creditor, or a lender and a debtor. And under a conditional sale contract, the seller retains title, just like it does in a dollar lease, in theory, until the last payment is made. But for some reason, even though there seems to be no real difference between conditional sale contracts and buck-out leases, nevertheless, there's an exception both to licensing, for licensing reasons, and you know, for this section, because under the definition of a commercial financing transaction, you won't see conditional sale contract mentioned as part of that definition. So in a commercial financing offer to a recipient that's made by a provider, before consummating the transaction, you must disclose the total amount of funds provided, the total dollar cost, the term or estimated term, the method, frequency, and amount of payments, a description of prepayment policies, and the total cost of financing expressed as an annualized rate. I think that's pretty similar to what Robert said about New York law as to what has to be disclosed. Let's see. One of the things we did was we gave, I know Robert gave like a chart for New York, and I sent to Blair Dawson the current version of the regulations, because they're long, they're involved, and they're somewhat complex. And we were going to try and send them out to everybody. And apparently we couldn't do that. And I don't know whether or not they talked about that or not before I got on the line. But in any event, if anyone wants a copy of the California regulations, just ask Blair. She's got them, and she'll send them to you. And I think it's the same thing with Robert's table from New York. But the regulations go into everything. They tell you exactly what's supposed to be in the disclosures. They tell you the format under which they're supposed to be made. And so, you know, I was hoping that, you know, that if you all had these regulations, we could kind of go through them a little bit, but I guess that's not going to happen. But, you know, like I say, there's like 30 pages of them. So it's not something you can just put on a board and, you know, let you look at them. But there are some general formatting things that is necessary, and it's in Regulation 2060. And at the top, it's supposed to say offer summary. At the bottom, it says California law requires this information to be provided to you to help you make an informed decision. By signing below, you are confirming you received this information. And then there's a space for a signature and a date. And then you're going to have the estimated term disclosed in units of years and months. And you assume that there's 30 days in every month and 360 days a year for purposes of the disclosure. So a term of 400 days would be disclosed as 1 year, 1.33 months. The annual percentage rate is to be expressed to the nearest of 10 basis points. And there's, you know, a few other things in there. When you're dealing with like factoring or open-ended transactions, as opposed to closed-ended transactions, open-end meaning that you can continue to advance under the documents, as opposed to a one-time lending of money. All you have to do is use examples. So let's say, you know, you have an open-ended transaction for $400,000. Then you use an example, even though you haven't advanced all the money, of you make $100,000 advance, you use that as your example. Same thing on a factoring basis. If in fact you've got $1 million you're lending, then you don't have to do it at all because it's over the $500,000 threshold. So long as that $1 million is being lent in good faith and you're not doing it just to avoid having to make disclosures.
Andy, this is Chad.
Yeah.
I'm going to jump in just for a minute. We have a few questions that have come up. I'm going to ask the panel to address. So number one, this is from Paul Bent. Doesn't incidental fall within the time payment doctrine? So I'm not sure if you want to handle that, Andy, or if Shervin or Robert want to jump in.
I don't think incidental has anything whatsoever to do with a time payment doctrine. The time payment doctrine is certainly something that gets you out of usury when you're dealing with something like a commercial, like a conditional sale contract. Or the time payment doctrine has been used to get people out of usury when you're paying on credit cards. That is, if you can acquire something for a certain price and you choose not to, and you're making payments over time, but the interest rate is more than the usury rate, which in California right now is 10%, then you can use the time payment doctrine to do that. I don't think incidental has anything to do with it. Could be wrong.
Hey, Andy, would you say, I mean, I know you're close to the regs and to the law. Would you say, incidental is more going to the scope and nature of your business?
Yes.
Okay.
That's what I think. Paul's a pretty smart guy. He might have a different opinion.
Next question here. Will the California law/regs apply only to California borrowers or to any borrower, wherever located, if the financing contract provides for application of California law?
I was just getting to that.
Okay.
Regulation 3025 is entitled Recipient's Relationship to California. The requirement of section 22802, and that's the section that says you have to make these financial disclosures. Subdivision A of the code applies only to recipients whose business is principally directed or managed from California. Principally directed or managed from California.
So I'm gonna jump in here. I'm Shervin Rushdie, Slim Capital. Been kind of working with Andy quite a bit over the last several years with the same little the same topic in mind, this moving target, which seems to be coming into further focus and becoming more of a reality. So as part of that, there's been a lot of things that have been floating around. Thank you, Andy and Robert, for some of the clarification on these so that we could get into a little bit more of the real fundamentals. So I guess part of this whole thing from a funder, a lender, a lessor, even a broker's perspective would be, how is this going to impact my business? How is this going to impact sales? How does it change the scope of how we have to go through our processes? And so as such, we've been looking at it over the course of several years now to say, well, we've always known that the operating and true lease definitions should end up becoming exempt. So automatically that could be something that could be that could help move away from these disclosure regulations. However, as we know, that's not always the easiest or most practical solution for the clients. So in looking at that, I'm here to offer a little bit of a perspective as, call it, the end user of these laws, as many of you are, to say, well, if we're talking about the disclosure of rate, aside from just saying, well, that kind of goes against the grain of the leasing world, because the leasing world is really predicated upon, you have a need for capital, and the cost of ownership is going to be far outweighed by the benefits to the business. And so that delta is really where we're looking from the payment standpoint. Well, yes and no, because there's all different types of clients. that will come into play that have different needs or have different kind of pain points. We offer, for example, credit-based solutions that are highly rate sensitive, typically in nature. And then all the way on the other side of the spectrum would be the collateral-based structure types transactions where, you know, credit might be challenged, but there is still going to be a deal to be had there through some kind of structure. So in terms of the sales side of things, generally when you're going kind of down market, rate becomes less relevant. However, it becomes more of an issue when the number comes into real focus for those folks. So if there's a situation where they're considering themselves for financing, yes, they may have had some trouble, checkered his credit history, they're willing to come up with the structure, yet can they stomach seeing a high teen or 20s in front of the number? That might make all the, you know, the entire deal fall apart for them, despite the fact that they have the ability to earn more upon, on this type of transaction. That's one scenario where it would be a challenge to have this type of setup because of just the psychology of it. So if we're just talking the psychology of it, the other end of the spectrum, the credit base, sometimes it's a big winning point, but because you say, hey, this is as clear as day, this is the rate, etc. However, and I was just having this conversation yesterday with a client that was grinding on rate and coming up with different rate formulas. So one of the questions that I had was, and Robert and I were speaking before this, was is there any kind of definition that could normalize the yield calculations? And he addressed that earlier because he said the method for calculating is based on the Federal Truth in Lending Act. Well, that helps to some extent, but then as we know, it's not your standard typical mortgage where you have, you know, a set number of payments and it's in arrears and there's an interim rent, interim interest portion, et cetera. There's all kinds of, you know, there's the first and the last, and then you've got the next payment in 2 months from now. So those little nuances could affect and impact how the rate is calculated and presented, and could be the difference in how a competitor comes to the table and is able to win the deal, is able to present something a little, literally yesterday it was within 0.3 percentage points. And I was trying, and he had gone, the client had gone to Google Calculator, plugged in the number of payments and the first and netted out the first and last, and yet he wasn't realizing that his first payment to us would not be until another 40-50 days out. And so that inability to figure out that part of the calculation was leading to that disparity. So what's kind of troubling in that sense, in terms of the disclosure, is it's not necessarily a level, even playing field where people just say, hey, what's your rate? And you run with that. So with that being said, I think that the yield expectations is one of the ways that we're looking at it to understand where we are open and happy to present, but having some kind of normalization where there is a very similar way to calculate these would probably be in everyone's best interest. And then, of course, then we talk about, well, how do these impact the different types of lending? So I know that and I'll come back to Andy's earlier point about the conditional sale and operating leases and everything. But if these are strictly for California borrowers, exclusive of those exemptions that you described, and for New York borrowers, I'm assuming, Robert, that's the same definition in terms of who has to receive these disclosures. Domiciled in New York, is that similar definition?
We actually don't have the reg yet, so we do not have clarification on that. It could be a point of interest to an argument, although it's clear, certainly with the 4 transactions in New York, that it's aimed at businesses at least located in New York.
Okay.
We don't have the better manage and you know that Andy talked about. We don't have that in New York yet.
Okay. And so one other point that I did just want to clarify, because we did talk about this before we go back to the conditional sale and some of these definitions, because that's also in the chat, I noticed as well, is the usury laws do not change across these lines, because if you have, for example, your jurisdiction laws, your documentation that has your jurisdiction, let's say in California, and you're lending to New York, so you have to put those disclosures in play, but with respect to what the usury laws, et cetera, you could still carry those from your state. Can you guys speak to that, please?
Well, Robert, do you want to start, or would you like me to?
Go ahead. You can go ahead, Eddie.
Okay. So, as you know, Robert's usury issues aren't quite what ours are, in that, you know, New York has very different usury laws. I don't even think there is usury for a corporate borrower. But
Not civil, not civil.
Not civil, it's criminal, right? And then there's like a 35% rate or something ridiculous out there.
Yeah, I think it's 26%, above
Okay.
26.
But here we are, which is the federal discount rate from the federal bank in San Francisco, or 10%, which is ever higher. And so for many, many, many years, the rate of usury out here is 10%. And therefore, it becomes really hard for a lot of lenders to make any money out here that they need to make. You know, bankable credits are one thing, you know, that they're going to have less rates. Usury, the penalty for usury in California is if the transaction is usurious, you have no interest rate at all. It becomes a zero interest loan. Any payments that were made that weren't applied to principal but were paid to interest are now applied to principal. And if the court finds that it's willful violation, they can be tripled or trebled. And then then you have to pay their attorney's fees, and you can still potentially get punitive damages, although I've never seen a punitive damage usury case before. So those are what the penalties are for usury out here. Now, as far as, let's say you've got a New York choice of law clause and you've got an 11% loan to a California borrower. What is the court going to do? And my answer to you is, I don't know. And the reason I don't know is that there are cases out here going both ways that say, look, usury is a public policy issue. We're here, California is here to protect our borrowers. And therefore, we don't care what the New York choice of law says. We're not going to apply New York law because now it's not a usurious rate under New York. Instead, we're going to apply California law. And the last case I saw on that, I could kind of understand, because bad facts make bad law. So a Nevada corporation was making $1,500 and under loans to military personnel in California, and Nevada has no usury. And so what the court said is, hey, you're not going to take these consumer loans, you know, that have this high interest rate to the military people out here, and we're not going to apply Nevada law, even though your documents say it's Nevada choice of law. Now, there are cases that follow that as well in the commercial context, but there's also a number of cases that say, well, wait a minute, this is a commercial transaction. You selected that law, and you know, it's reasonably related to your transaction. Your lender is in New York, and you agreed to it, and so we're going to enforce the choice of law. I've always suggested to my clients that they have to take the conservative approach and believe that you know, they've got a problem, notwithstanding a choice of law clause. You don't know what's going to happen, you know, what a court will do. And so that's what would happen out here in California with the choice of law clause. Let's say it went the other way around, where it was a California choice of law clause, the borrowers in New York. What would happen, Robert?
Well, I tend to agree with you. I'm always fearful of what a California court is going to do. I think I would make the exact argument that you were saying, which is, there's the law reasonably relates to that transaction, and the parties agreed, obviously, to have New York law apply, and it should be applied. It's hard to say. I mean, particularly with any given court as to how they're going to come out. There's always that tension between, the public policy of the state and the individual that's allegedly harmed. And, obviously these are sophisticated parties to a commercial transaction that knew what they were bargaining for. And so that's always the position that I take. And just to clarify for New York, there is civil usury, but you can't assert it as a defense if you're a corporation or an LLC, which is usually what we're dealing with here. So then there's civil 16% to essentially 25%, and then 26% above it is criminal. And then there's also an exception, which rarely comes in, for Article 9, certain Article 9 transactions over $100,000. But Andy, I tend to agree with you. I think it's a dicey question. And I think that it's going to certainly depend on the forum that you're in, and the judge that you have.
Yeah, all I would say is if I were in your shoes and, my lender client came to me and said, well, should I file in New York or in California? I would definitely file in New York, hoping that, the argument would not be made that it's a California borrower and therefore California law would be applicable.
So also just to that point, if it's a California borrower, wouldn't you by definition have to have a lender's license, which would exempt that usury law anyway?
Well, you should have a lender's license,
Exactly.
unless you're exempt from, usury like a bank is.
Right.
You should have one. And so, obviously there's a downsides of lender's licenses, like all the reporting you have to do, the fact that a lender's only supposed to be doing business with other brokers or lenders that are licensed. So there are downsides to having the license, but the upside, if you're not an exempt lender, is that you need the license, and then you're exempt from usury. Now, remember though, usury only applies to loans or forbearances. It doesn't apply to conditional sale contracts. It doesn't apply to true leases.
Perfect segue. So I think a lot of people on this meeting are trying to understand how they could in fact incorporate. I think operating leases stands for itself in terms of FMV and defining that. But I think there's some questions and buzz about this conditional sale definition. And I know that, Andy, it's still not set in stone how you could, because it could, I understand a court could pick it apart however they see fit, but could you shed some more light on that as to how that could be implemented and documented to partake in this exemption?
Yeah, well, as I said, previously, the way you document them is it's always going to be for a sale of goods. So, if there's any services or software or something like that, you're going to have a real hard time saying it's a conditional sale contract because it's always a sale of goods. And, you just reshape your lender lessee into buyer debtor or buyer and seller.
Mm-hmm.
As part of it. And, you indicate that title remains with the seller until such time as the last payment is made. I have clients who are using them now for a lot of transactions in order to try and get away from issues regarding loans.
And Andy, I assume that you need to have it say that is a conditional sales contract. There's no going back or interpretation that it's an EFA later is a conditional sales contract. You're going to lose that argument in court.
Yeah, EFA is you're going to lose that argument on an EFA, especially because look at what you're calling the parties. You're not calling them buyers and sellers.
And so even though there's a third party vendor that's effectively selling the goods, the buyer, the seller in this context becomes the party to the agreement that's doing the selling. How does that portion work? Does that change anything in terms of the disbursement or the commencement or any of those aspects?
Well, the lender who's acting as the seller is going
Yes.
to be on the contractor invoice as the buyer from the supplier, and they have to pay for it, and then it's the way it is. It doesn't really change a whole lot.
No issue with, Andy, with warranty issues now that you're stepping into the shoes of potentially being a seller?
Well, all you can do is disclaim them, just like you would do in your dollar out lease or anything else. You're gonna disclaim all warranties.
So I think most of the folks on this call also really understand those sections in there and portions of their documentation that have really broken from any kind of reps or warranties related to the serviceability and usability of the equipment, et cetera. So those would hold true as well. So very good. I think that covers a lot of the questions. I mean, this has been incredibly informative. I hope it's really helped many of the folks on the call. I don't see any other questions coming up. I want to I think if there's anyone else that has any questions, please feel free to jump in. If you guys have any kind of closing statements or anything, or if you guys have any questions, please feel free.
No, just for the record, Andy, I'd never advise a client to file anything in California.
This is Paul.
Gentlemen.
I feel compelled to respond to my friend Andy's comment. I think there is a strong connection between the incidental usage and time payment doctrine. The whole purpose of the whole thinking behind the ancient time payment doctrine is if you're selling goods, if you're a seller of goods, you can, if that's your primary business, you can in effect finance those goods or make the goods available on a time payment purchase contract or a time payment purchase arrangement. And that arrangement historically has been, as you said, exempt from usury constraints. But in the context we're talking about today, it seems to me that could well fall within the time payment doctrine. But I think I understand what you're saying too, Andy, about buyer and seller. I completely agree with that, because your main business is selling the goods. If you're selling refrigerators and your buyer wants to buy a refrigerator for $1,000, he says, I don't have $1,000. Well, great, I'll sell it to you for $100 a month for a year. Well, that you'd break the usury law if you did that. But under the time payment doctrine, that financing, if you want to call it that accommodation is incidental to the sale of the goods. That's what I was getting at.
Paul, let me just say that I think
For
you're
whatever
right.
that's worth.
I think you're right, but under the scenario that you were painting, where there's a sale over time, it's probably not going to be documented as a loan. It'll be documented as a conditional sale, and that's what gets you out of it. If you're making
Exactly.
a loan, then you're into the incidental issue.
No, I think you're absolutely right. It would be a conditional sale. The time payment doctrine is really sort of embodied in the conditional sale agreement. You're absolutely right. I mean, they tie together in that way.
Well, gentlemen, thank you so much for your presentation. I noticed that we have Scott Reel from ELFA. He's the VP of Government Relations on, and he and I were messaging back and forth. Scott, do you have anything to add?
Chad, thanks, and congratulations on your new position. I think NEFA's got great things ahead of them. This has been a wonderful discussion on the two issues I think at hand, and that is California and New York. And fortunate that my two godfathers, East Coast and West Coast, were doing the presenting. Andy's a very active part of what we call our DBO work group, ELFA's DBO work group, and Robert has been someone that I've been sharing information on issues in New York and New Jersey, for the better part of the last 2 years. So I guess what I would add, and I would just caution that if there is anybody, I know this was an open, Zoom, if there's anybody that reports for the press that this is going to be off the record. My comments are off record, and I would hate to see anything in print. And I say that simply because a lot of the things that we talk about are strategy and what we're trying to do to protect the industry. What I can only add to what Robert and Andy had discussed is maybe a little background. I think most people don't even know when the California lender license law even was first enacted. I think it became so much more important to our industry when the DBO became uber active in regulating it. We heard about the $500,000 threshold, in the disclosure bill in California. If anyone wants to know exactly where that came from, it came from thin air. I talked to Glazer and I said, because we were pushing for a $10,000 limit. In other words, you were exempt unless you were doing something for anything over $10,000. And they pulled it out of there. They said, well, that sounded good. And so we go to New York and we've got 500,000 there, and they go to 2.5 million. And I was talking with Robert, and I think the only thing that they think is that, you're certainly, both in California and New York, they're worried about allowing people that they're trying to regulate to get through under any exemptions that they may give to us. We fight very, very hard for exemptions. And I think maybe they think that anybody who's doing more than 2.5 million are okay, and everybody under 2.5 million might be people we need to worry about. And they're all worried legislatively across the country. The worry seems to be with merchant cash advance and factoring, and in some instances, the fintech of the world. The bills also don't start in the same way. Finance disclosure legislation in California started because of Glazer's desire, I think, to protect small business. In New York, it was actually an industry pushed bill because the fintech companies for the better part of 2 years were really under the microscope of the Department of Financial Services. And they thought they were on the verge of being regulated by the Department of Financial Services. And so they wanted to get ahead of it and figure out what kind of regulation they could live with. Well, that's all well and good, except if it starts to hurt our ability and do what we do best. And so that's what requires us to kind of go in and try to get as broad an exemption as possible for our industry. And the best way we've been able to determine that is to, go to the UCC and explain how we are different. And the one way we can talk about being different is that none of the other parties can say that they are regulated or guided by the UCC Article 2A and 9 and secured transactions of 9. And so that was the difference that we were able to push to get the exemption in the New York financial disclosure law. I don't, Chad, want to indicate to the people that financial disclosure isn't something that's critically important to our industry. It is. I'll let you know my biggest concern are additional states doing California finance lending licenses. And that is what we are facing. And, God help us if we ever get to a point where we have 50 states of finance lender license that are on the NMLS lending platform. It would be very, very bad. And so not every state is alike. If something comes up in North Dakota, how much equipment leasing financing are we doing in North Dakota? But New York, California are important states. So we do have lender license legislation that's been introduced in the Assembly and in the Senate in New York, and it's introduced by important people in both places, in both chambers. So we are very, very active in making sure that if lender license legislation passes in New York, it does so with as many exemptions we can get to protect the industry. And New Jersey is watching things pretty closely. So the goal for us is going to be to kill, render harmless, or amend legislation in New York and use that as leverage what we need for New Jersey and any other state that comes on after that. I hope that is a good overview of kind of the concerns that ELFA has for our industry and where we are kind of digging our trenches and going to battle. But we're on the ground in New York, and we're really need to make sure that, you know, if finance lending license occurs, we're well positioned to be exempted. One thing I will add, and Robert will know this, the thing that is completely bass backwards is that there's already a finance lender's license on the books in New York. It says if you do anything under $50,000 over 16%, you need to be licensed. And that's never really impacted a lot of ELFA members, and so that wasn't a big deal. The new law that they're proposing doesn't even reference the law that's on the books, and not sure how much we're going to do to point that out to them or to argue with them about that. If this thing's going to go, I just know that we want to be exempt. Chad, thank you for the opportunity, and Robert and Andy and Chevron, thank you.
Thank you, Scott.
Yeah,
Thank you,
appreciate it,
Scott.
Scott. Thanks for your insight.
Oh,
Yeah,
Chad,
thank you guys. Yeah, go ahead,
Chad,
Robert.
just want to add one thing here that I didn't mention during our talk, which is New Jersey, as far as financial disclosure law. New Jersey did pass a financial disclosure law. It didn't get signed into law. It's hanging out there still, and I fully expect at some point that it'll move forward. Believe it or not, New Jersey may have the model. It may be the better. I actually know it is the better of the laws, in the sense that ELFA and Scott were great in getting exemptions for both Article 2A and Article 9 in the New Jersey law. Plus, the New Jersey law actually defines what a small business concern is. It's a company with, I believe, $1 million gross revenue per year or something. So if we want to talk about where we should be going policy-wise, and disclosures are good, that's the sort of, you know, thing where we have some parameters and we really are targeting small businesses, that it may be sort of the model legislation. I'm not saying that one in particular, but that sort of circumscribed law may be the one to look at.
Yeah, let me just add, if I might. I traveled overnight to get to Trenton to get those exemptions in the New Jersey law, and we've got a really good relationship with some of the leadership there. Yeah, New Jersey, I think we're good. But the problem with New Jersey is because the disclosure law didn't pass. I think what they're going back and trying to do is they're going to combine disclosure and licensing all in one bill, and so that's what we're going to have to. That is what we're staying abreast of, and making sure that. So obviously, one of the arguments that we're making in New York is that we were exempt. The legislature just exempt, and the governor just signed a bill that exempted leasing. And so that is what we're arguing for licensing, is that we just asking them to stay consistent. Well, we would do the same thing in New Jersey, to stay consistent with their exemptions between disclosure and licensing.
Yep. Great.
Great, thank you.
So I know that Robert and Andy had put together some information regarding the disclosures. Robert put together a nice chart. We're happy to share those. So if you want, I think, Blair, were you just going to send those to anyone that requested, or take a list of all the participants? And also stay tuned, because there is more action after this. So Blair.
Yeah, I can send it out to everyone who was on today. We had about 140 people on. So we'll send everyone out that list and the regulations.
Great. And then you said there was a happy hour, I think?
Yeah, immediately following. No, please stay tuned for a brief networking session if you guys want to turn on your cameras and your microphones, and kind of get to say hello to everyone and see some familiar faces on here.
Thank you,
Thanks, Blair.
Blair and Chad, for having us on, and thank you, Andy and Robert, for very, very informative information for us, knowledge.
Thank you. Thank you all for joining us today.
Yeah, thanks, gentlemen. So yeah, we're going to move into the next phase of our session. We're going to spend about 15, maybe 17 minutes with just an open networking session, since we can't meet in person presently with the COVID situation. Feel free to turn your mics off, turn your cameras on. We're just going to have kind of a round robin. And I guess I can throw out a question. What does everybody feel about Q1 as far as business potential? We can start there and we can just go in whatever direction you wish. This is just intended to be purely networking. From what I've gathered from our board, this group is very family oriented, and you love to connect and network, and we love to be in person when we can, which we will eventually. But again, I'll just open the floor and feel free to jump in.
Don't everybody jump at once. Hi,
Right.
I'm Paul in California. I'm going to leave my camera off because I don't want to scare anybody. But, you know, I'm a one-man brokerage in Irvine, California. I've been in the business for too long. I have been very privileged to know some very active persons in the industry. You know, I'm working out of my residence. I'm actually doing great. I'm very optimistic about this coming quarter. Things have gone fairly well last quarter of 2020. I think if we can all get vaccinated and get back to some sense of normalcy, I think we're going to have a spring fever of sorts, kind of a, I think there's a lot of pent-up demand.
Yeah, thanks, Paul. Anyone else?
I'll echo Paul's statements. Kevin Carr, I'm with Paston GPS. We service a lot of the commercial truck and equipment finance companies in the subprime segment as a provider of GPS tracking with our wireless solution. We've seen a huge uptick over 2020 with more commercial truck finance companies joining our company, utilizing our technology. I've actually seen a lot of increase in demand. We continue to build on our solution. Our finance companies continue to grow. Our brokers continue to grow. So we're seeing a lot more brokers moving to direct lending, direct funding source. So we're very optimistic. Unfortunately, I was informed today of a partner that due to COVID had shut their doors. So that was very unfortunate. So all we can do is help encourage that we protect portfolios with our tracking and see our clients continue to grow and expand their portfolio to other markets in the subprime finance industry.
Thanks, Kevin.
We actually see a lot of the same. What started last year was back in March was a lot of uncertainty, a lot of the unknown. What will come back? What will happen? How will things survive? What will be the longevity of this? And through that uncertainty, I think we were able to see, at least from our perspective, quite a bit of pivoting, because there was a lot of opportunity that did spawn from the pandemic to support businesses, to support various types of activities that in terms of manufacturing and construction. And there was a direct correlation between those businesses that were starting to really proliferate and grow and expand away from those that were hardest hit, which are, of course, in the restaurant and the gyms and those kind of non-essential, if you will, which I don't agree, businesses that now we're starting to see some of those have a way back to opening. We're starting to see more and more of those types of transactions come across our desk. And I think with the vaccine, with there being more certainty on the PPP, the forgiveness, where that stands, the second round, I think a lot of people are starting to stabilize and have a little bit more wherewithal and guts, call it, to come back into the marketplace and to lend to the marketplace from the other side of it. So, you know, given what we have all just gone through, it certainly feels like the worst is behind us, because there is a lot more history and experience and some kind of clarity ahead, both politically, with government help, and the focus with the actual resolve for the pandemic. So,
as an attorney, I'm kind of interested to know whether or not everybody's still giving deferrals and forbearances at this point. I've seen a lot of deferrals and forbearances and the like, but it's been a long time now, and whether or not the lenders are still out there giving them.
So this is Ellen Miller from North Mill Equipment Finance. We never really did deferrals. We put people into payment plans that reduced their payments for a short period of time, and then did a few restructures. But that came to an end, and we are now business as usual. If people are not able to make their payments, you guys are getting our business. I know Martina's on. We're keeping her very busy. And I see a lot of familiar names, and we're trying to be business as usual. We still have a few people that are struggling that we're trying to work with, but trying to keep their accounts paying.
I guess I could jump back into Andy, but when we first started to get the deferral requests, a lot of folks were what we call tire kickers, because the banks were kind of offering it carte blanche, and we had to readjust that scope for our clients and let them know that, listen, we're not a bank, and we really want to understand what the reality is for you. So we asked for some information, bank statements, et cetera, and then a lot of that allowed those folks to just say, well, I was just asking, I didn't really need it because I have the help I need, and that flushed some of those out. And then on the other side, we were doing 1 month at a time. So we weren't doing 3 months. We were looking at it 1 month, and we saw that funnel down and kind of normalize things over those 90 days or so. Some folks carried through that period and then came to us later on and said, hey, I thought that things were going to turn quicker, and they haven't, and we need some support. So we have seen some of those. I could say that as of late, thankfully, there's been a lot more balance and kind of normalcy in that. And I know there's some other folks on here. I'd love to hear also what, Kip, Larry.
Mark Stern from Eastern Funding. We did 3-month deferrals right out of the box, not asking a lot of questions. And then we offered interest only for 3 months, and only about 20% of the people that took the first round of deferrals asked for it again. And now we are selectively, and on a very few cases, offering additional assistance to the customers that need it. But it's dwindled way down from where we were when we first started.
Any other comments on that subject?
Yeah, Mike Miller here. Same thing as Mark. We did the same similar pattern, but after 90 days, pretty much everybody was in good shape. What we found interesting was the amount. We have an early payoff, so you can pay it off at any time with no penalty or future interest charges. We had 10% payoff. We even saw that in our credit card business. Even though the volume went up on, well, we have merchant and we have credit card. We saw the volumes go up because people were now using the merchant terminal, but the balances were going down. So we were getting the transaction fee. But as far as that, also what we found, we got authorized to do PPP loans for our chiropractic business. And the first round, we did a significant amount because the smaller people were getting left behind because they were using, going after the larger amounts. And then what we found, now we just opened up the second round, and we're seeing a significant amount of people do that as well. Now, we're not sure, they have to show that decline of 25%. So they're all checking that box of the quarter where it went down, so they qualified. But we'll see how they have to prove that going forward. But we're still seeing demand there. Now, what we did find, though, is because we have a little working capital loan for 20 grand, we throw out there for them too as well. They didn't take advantage of that. So we're thinking that the PPP money basically filled that gap and filled what they need. So I guess we'll see what this next wave goes, 6 months later. But, as you know, all of them, most of them were under 50 grand. So that all got forgiven. So we've not had too many issues of getting it forgiven either. So it's kind of what we're seeing.
Yeah, the only thing I would add is from here at Dedicated, just on the third-party collection side, is we shortened our window of follow-up. So we went to like basically weekly follow-up with a lot of people, even if they were paying, just seeing how they were doing and just being super high touch with all of our accounts. And that led to a lot of people, as soon as they were able to readjust those mods back up. So we didn't really defer things out for a month or two. At first we did, but now we've done a lot more switching, maybe a monthly to a weekly and cutting it down. And then just, so we're just following up with them a lot more. And it's allowing us, as soon as they're able, they're communicating like, hey, I'm now able to increase that back up or go to where I was. So I don't know if that helps anyone, but that level of follow-up ended up helping us dramatically rebound that by between PPP and just that level of communication. We were, in a great place by June, and we've followed up with that same thought process as we're in round two. But round two isn't affecting third-party side, and if you're using third-party agencies, I don't think you're going to see, if you saw a spike from them at all in performance, you'll see it on the second round, because most of your companies have held on to things more internally, and by the time stuff is getting to us, they're not getting that access to that second round. They're probably dead in the water at this point. So I wouldn't expect the same performance level that you may have seen out of your third-party vendors if you're using them on the second go around.
Thanks, Sean. Any other comments? Just a couple of things from the NEFA side. I'll just be very brief with these because we're coming up on our time. Number one, I guess if you have not renewed your dues, if you could do that by month end, we'd appreciate it. We have monthly board meetings, and we have a board meeting coming up early February. So I'd like to give a report to the board at that point. So if you could do that, we'd appreciate it. Secondly, we have a new team member on staff with NEFA, Steve Elworth. He's our Director of Membership and Sponsorship. He's going to be reaching out to all of you, making introductions and connecting with you just to make sure that you're getting value out of your membership and look at different opportunities for you to be connected. We're going to have about 10 of these programs this year, similar format, 90 minutes. Blair can speak to you in just a moment on what we have planned for the rest of Q1. But our plan, since we can't get in person right now, is to do these in lieu of in-person meetings. And then we have some things planned in March, and then we are tentatively planning some regional meetings later this year. And then we're gonna have a blowout party in Charlotte in October, assuming that we can go, and it's gonna be a great time. We're already starting our programming and planning there. So things will be a little bit different for you when you show up in Charlotte. I'll just give you a little teaser there. So we're gonna try and ramp up what we do for you and provide some excellent programming and excellent networking opportunities. So with that, I'm going to turn it over to Blair for just a minute. She can give you some updates.
Sure. So just a few items to add to your calendar. Our next one of the series of the virtual exchange is Emerging Tech in Equipment Finance, the Risks and Rewards of AI and Machine Learning. And that is going to be on February 2nd, 1 o'clock to 2:30, same format. Then in March, we are going to have our virtual finance summit. So we have 2 days of programming, March 16th to 17th. Please mark your calendar. Registration should open about February 1st. We should have about 10 educational opportunities, including keynote speakers and panel discussions. We have booths, and we have other opportunities for networking throughout the virtual conference. So mark your calendar. Please look out to join us. We're really excited about it. And as Chad teased in October of this year, in Charlotte, we will be having our funding symposium in person the 13th to the 15th. So mark those dates on your calendar and look in your inbox for information about how to register, and hopefully we'll see you soon. All right. Thanks, everyone. Thanks for joining us today.